What if I told you that everything you're seeing on the news, all the price predictions, the ETF flows, the fear and greed index, are all just noise designed to keep you distracted from the real move that's happening right now? There's a single undeniable chart buried deep in the on-chain data that paints a picture so explosively bullish for Bitcoin that it makes my hands shake just talking about it. This isn't a theory. This is a mathematical certainty playing out in real time, and the institutions who understand are currently engaged in the most aggressive silent accumulation campaign in financial history. They are buying up Bitcoin not for the prices you see today, not even for $100,000, but for a price target so audacious that saying out loud would get me laughed off of mainstream financial television. But I'm not here to be popular. I'm here to show you the truth. And the truth is that a signal is flashing bright red, not for a crash, but for a supply shock of biblical proportions. And if you understand what this one chart is telling you, you'll position yourself accordingly and potentially change your life forever. I'm going to show you this chart today. I'm going to break down exactly what it means, pixel by pixel, and I will reveal the exact price target that the world's most sophisticated investors are secretly banking on. But before we dive in, I need you to do something for me. Smash that like button right now and ring the notification bell. I am not exaggerating when I say the information in this video is the most valuable thing I have ever put out, and you are going to want to watch this entire thing without any distractions, because the clock is ticking and the window of opportunity is closing faster than anyone realizes. Now, let's pull back the curtain. To understand why this moment is so critically unique, we have to first talk about what Bitcoin really is at its core. It's not just a digital currency. It's a meticulously designed protocol for truth, a system of immutable scarcity where the code is the final law. And the most critical line in that code is the hard cap of 21 million coins. We all know that number, we throw it around, but I don't think we've truly internalized what it means in a world of infinite money printing, where central banks can create trillions of dollars, euros, or yen out of thin air with a few keystrokes. That 21 million is the anchor in a sea of financial chaos, the one asset in human history whose supply cannot be inflated by decree, by war, or by the whims of corrupt government. This absolute scarcity is the bedrock upon which everything else is built. But scarcity alone isn't enough to trigger an explosion. You need a catalyst, a fundamental shift in the demand side of the equation that runs headfirst into that unyielding supply wall. And that, my friends, is precisely what is happening right now. And it's happening in a way that has never occurred before in Bitcoin's entire 15-year history. We've had demand spikes before, don't get me wrong. The retail mania of 2017 was a demand spike, driven by a frenzy of speculation and the ICO boom. The 2021 supercycle was a demand spike, fueled by unprecedented fiscal stimulus and the narrative of a new digital gold. But those were waves. What we are witnessing now is not a wave. It is a permanent structural and irreversible tectonic shift in the very foundation of the global financial system. The players have changed. This is no longer a game between retail traders and crypto whales. This is a new battlefield where the opponents are nation-states, trillion-dollar asset managers, and publicly traded corporations, all competing for the same limited pool of available Bitcoin. And when a BlackRock, a Fidelity, or a sovereign wealth fund decides to allocate even a single percentage point of their gargantuan portfolios to Bitcoin, they aren't buying 10 or 100 coins. They're buying tens of thousands, even hundreds of thousands of coins in a single order. They operate on a scale that the market has simply never had to absorb before. This is the context, the grand stage upon which our secret chart is performing. It's the clash of an infinite demand from a new class of financial titans against the most finite monetary asset ever created. But to see the real proof, we have to leave the headlines behind and descend into the blockchain itself, into the cold, hard, unforgiving truth of the data. Because while the media talks about ETF flows, which are important, they are just a surface-level symptom of a much deeper, much more powerful phenomenon occurring in the dark pools and on-chain settlements where the actual coins move. The real story isn't who is buying through an ETF. The real story is who is taking direct, sovereign custody of their coins, and more importantly, what they are doing with them once they have them. And that is where our story takes a dramatic turn, because the behavior we are seeing is not that of short-term speculators. It is a behavior of long-term strategic holders who have no intention of selling for any price you or I can currently imagine. They are locking up the supply, and they are doing it with a quiet, terrifying efficiency. So, let's talk about this lockup, this great migration of Bitcoin into cold, impenetrable vaults from which they may never emerge again. You've probably heard of the term hodling, but what we are witnessing now goes so far beyond that. This is a fundamental transformation of Bitcoin's liquid supply, and it's the core component of our secret chart. To understand it, we need to look at a metric that, frankly, doesn't get the glamorous headlines, but is arguably the most important number in the entire crypto ecosystem right now: the illiquid supply shock. This isn't a complicated concept. It simply measures the number of coins that are being moved from easily tradable liquid wallets, like those on exchanges, into illiquid wallets, which are addresses that have little to no history of spending their funds. These are the black holes of the Bitcoin universe. Coins go in, but they don't come out. And for the past 18 months, during a period of mainstream media has labeled a crypto winter or a bear market, the rate of coins flowing into these black holes has not just been steady, it has been accelerating to a breathtaking pace. Think about that for a second. While the narrative on television was fear, uncertainty, and doubt, while retail investors were being scared out of their positions by predictions of Bitcoin going to $10,000, the smartest money on the planet was doing one thing and one thing only: buying every single coin that was made available and sending it straight into deep, cold storage. The data is unequivocal. Every single day, thousands of Bitcoin are being withdrawn from known exchange wallets. We're not talking about small amounts. We're talking about a net outflow that has consistently exceeded the daily production of new coins from miners. Let me repeat that because it's critical. The market has been in a state of net negative supply for over a year. More Bitcoin is being permanently removed from the readily available trading supply than is being created by the network itself. This is the equivalent of a giant global vacuum cleaner silently sucking up every last drop of oil while everyone is arguing about the price at the pump, completely oblivious to the fact that the underlying reserves are being systematically drained. And this brings us to the heart of the chart, the single most bullish configuration I have ever seen. It's not a fancy trading indicator with 100 cross-moving averages. It's a simple, powerful visualization of this illiquid supply shock. The chart plots the cumulative number of coins that have become illiquid over time, and the line isn't just going up, it's curving upwards, steepening at a rate that is frankly unsustainable. It's a parabolic curve of accumulation. This line is screaming one thing and one thing only: the available liquid supply of Bitcoin is drying up, and it's happening faster than anyone predicted. We are rapidly approaching a point of critical scarcity where the coins available for sale on the open market are so few and far between that the basic laws of economics will take over. When demand for an asset massively outstrips its available supply, the price is not a gentle suggestion. It is a violent discovery mechanism. But here's the twist, the part that the institutions understand and that most people miss. This isn't just about the US spot ETFs. As massive as those inflows have been, this is a global phenomenon. We are seeing sovereign nations, corporations in Asia and the Middle East, and ultra-high net worth families all around the world, all executing the same exact playbook simultaneously. They are all looking at the same macroeconomic backdrop: the runaway debt spirals, the de-dollarization efforts, the currency debasement happening in real time, and they are all arriving at the same conclusion: Bitcoin is the only viable life raft. And they aren't just dipping a toe in the water, they are building arcs. They are allocating not for a 10% or 20% gain, but for a 10x or 20x shift in the global monetary system. They are playing a game of chess while everyone else is playing checkers, and their strategy is brutally simple: acquire and hold at any cost. The cost, of course, is the price you and I see on the screen, and that price is a complete and total illusion. It is a phantom, a fleeting number that only exists because there are still a few weak hands left to sell. But with every coin that gets sucked into an illiquid wallet, the pool of weak hands gets smaller and smaller. The foundation of the market is being transformed from sand into diamond, and when the next wave of buy-side pressure hits, and it will, from a new ETF announcement, a regulatory clarity event, or a sudden banking crisis, it will hit a market that has no coins left to sell. The result won't be a slow, steady grind higher. It will be a vertical line on the chart. A price explosion of a magnitude that will rewrite the history books. This is a signal. This is a chart. the great illiquidification of Bitcoin. And if you are not positioned for this, if you are waiting for a pullback to get in, you're fundamentally misunderstanding the nature of the shift that is occurring. The institutions aren't waiting for a pullback. They are creating the pullbacks by shaking out the weak hands so they can buy more. Every dip is being bought, not by day traders, but by algorithms and treasury departments with near infinite capital and a multi-decade time horizon. They are building a position that they intend to hold for a generation, and in the process, they are systematically removing the very asset you think you could buy later from existence. The clock is ticking, and the sand in the hourglass of available Bitcoin is running out faster than you can possibly imagine. Now, you might be sitting there thinking, okay, the supply is getting tight, I understand that, but what about demand? Isn't all this institutional demand already priced in? And this is where we separate the hopeful from the truly informed, because the demand we've seen so far from the ETFs and the headlines is merely the first whisper of a hurricane that's about to make landfall. The current institutional buying is just the initial deployment of capital, the testing of the waters by the most forward-thinking and agile of these giant entities. The vast, lumbering titans of global finance, the pension funds, the sovereign wealth funds with trillions upon trillions of dollars in assets under management, have barely even begun their allocation processes. We are in the first inning of a 9-inning game, and the starting pitcher hasn't even broken a sweat. Let me give you a mental model that will change how you see this forever. Imagine the entire liquid supply of Bitcoin, the coins actually available for purchase on exchanges and through liquid instruments, as a small, pristine lake. For years, this lake was fed by a steady stream of new coins from miners and was large enough that anyone who wanted could come and take a bucketful without much trouble. But now, the stream of new coins have been cut in half thanks to halving, and more importantly, a fleet of industrial-sized pumps has arrived, each connected to a hose that is siphoning water out of the lake and into massive sealed storage tanks. These pumps are the relentless, daily accumulation by ETFs, corporations, and nations. The lake's water level is dropping visibly, alarmingly. But here's the kicker. What we've seen so far is just a testing of the pumps. The real demand, the demand that will create the explosion, comes from two places that are so large they're almost abstract. First, the mechanical, systematic allocation from index funds. When Bitcoin is finally included in a major stock index, the S&P 500, the NASDAQ, the Russell indexes, the buying will not be discretionary. It will be mandatory. Every single index fund, every ETF that tracks an index, every pension fund that mirrors it, will be forced by their own mandates to go out and buy Bitcoin. This isn't a decision. It's a mathematical inevitability. It will be a buying pressure that is utterly indifferent to price, a wave of capital that simply must own the asset, and will hit our nearly empty lake all at once. The second source of demand is even larger, the global flight from sovereign debt. The world is drowning in over $300 trillion of debt that can never be paid back, only inflated away. The entire global bond market is a slow-motion train wreck, and the smartest capital on earth knows it. They're looking for an exit, a lifeboat that is not correlated to the fate of the U.S. Treasury or the German Bund. Bitcoin is that lifeboat. It is the only major asset that is simultaneously scarce, globally liquid, and completely outside the traditional financial system. When the pension fund of a mid-sized European country or the sovereign wealth fund of an Asian nation decides to allocate a mere 1% of its portfolio to Bitcoin as a hedge against systemic collapse, that 1% doesn't represent a few $1 million. It represents billions. A single 1% allocation from just one of these entities could soak up the entire liquid supply for months. Now, imagine a dozen of them making that decision at the same time. This is not a fantasy. This is a logical endpoint of the current monetary trajectory, and the preparations for this are happening right now in boardrooms from Oslo to Singapore. They are not public yet, but the on-chain data doesn't lie. The movement of coins into deep, cold custody solutions designed for sovereign-level security is the telltale sign. They are getting their vaults ready before the stampede begins. And this brings us to the most critical part of our secret chart, the part that reveals the exact price target. The chart isn't just tracking the liquid supply. It's modeling the intersection of this collapsing supply and this incoming tidal wave of institutional demand. It's a simple supply and demand curve, but on a scale we've never seen before. The model takes the projected daily liquid supply, which is falling by the day, and divides it by the projected daily demand from just the currently known institutional pipelines, like the approved ETFs and the corporate treasuries that have publicly announced their intentions. The result is a number, a price, that represents the equilibrium point where the last available coin on the open market is purchased. This isn't a technical analysis target based on historical patterns. This is a fundamental mathematical calculation of scarcity value. And the number it's pointing to is so far beyond most people's imagination that it seems ludicrous. It's not $100,000. It's not $200,000. The model, based on this organic, on-chain data, points to a minimum viable price target of over $450,000 per Bitcoin within the next 24 to 36 months. Let that number sink in. $450,000. This is not me being bullish. This is the cold, hard logic of a supply shock meeting a demand shock. It is the price required to coax enough coins out of the hands of the most determined holders to satisfy the bare minimum of the incoming institutional orders. It is the market's only possible clearing price. The institutions know this number. Their quantitative analysts have run these same models. This is why they are accumulating so frantically now, why they are completely unfazed by 10 or 20% price dips. In the context of a $450,000 target, buying at $60,000 or $70,000 is a rounding error. It's a steal. They are playing for a 10-bagger from here, and they are using your fear and the media's short-term narrative to take the coins right out of your hands before you realize what you've lost. The greatest transfer of wealth in modern history is happening right in front of you, and it's being executed not with loud announcements, but with the silent, relentless clicking of digital transactions on a blockchain that never forgets and never lies. So, the question that remains, the only question that really matters, is what you would do about it. Knowing this information, seeing this chart, understanding the mathematical inevitability of the supply and demand collision, places a responsibility on your shoulders that you cannot ignore. This is no longer about speculation. It's about financial self-preservation. We are standing at the precipice of a fundamental reset of the global monetary order, and the dividing line between those who will be on the sidelines watching it happen and those who will actively participate and prosper from it is being drawn right now. Today, by the decisions you make in the wake of this video. The most dangerous thing you can do right now is to succumb to paralysis of normalcy bias. To think that the world you woke up in yesterday is the same world you will live in tomorrow, that the old rules still apply. They do not. The old rules said that assets go up and down based on earnings reports and interest rates. The new rules, the rules of the digital asset age, state that value is derived from absolute scarcity and immutable code, and that when a global flight to safety begins, it will rush into hardest, most verifiable money ever created. And it will do so with ferocity that will leave traditional markets in the dust. This is not just an investment opportunity. It is a once-in-a-civilization event, a chance to front-run the greatest reallocation of capital in human history. But to seize this chance, you must overcome the final hurdle, the psychological barrier that the system has spent your entire life building inside your mind, the belief that it's too late, that you've missed the boat, that the easy money has already been made. Let me be unequivocally clear. That is a lie, a narrative designed to keep you passive and poor. The easy money wasn't buying Bitcoin at $10. The easy money is buying Bitcoin right now, before the final, violent leg up that will take it to prices that seem like science fiction today. The real wealth is not made by selling at the top. It is made by buying before the tidal wave of institutional capital even arrives, by having the conviction to hold to the volatility because you understand the end game. Your greatest asset in this moment is not your capital. It is your time horizon and your emotional fortitude. The institutions are playing the long game, and if you want to win, you must do the same. You must adopt the mindset of a digital sovereign, an individual who understands that true wealth is not measured in the depreciating paper of a failing system, but in the permanent, scarce, and globally recognized hard money of a new one. This means taking direct, sovereign custody of your coins. It means moving them off of exchanges and into your own hardware wallet, where you alone control the private keys. Not your keys, not your coins. This is not a catchy phrase. It is a fundamental law of Bitcoin, And in the coming era of exchange defaults, regulatory crackdowns, and counterparty risk, it will be the single most important factor in determining who survives and who gets wiped out. You must become your own bank. It sounds daunting, but it is simpler than you think, and it is the ultimate act of financial defiance and independence. The system wants you to be dependent, to hold your assets in their custodial accounts, where they can be frozen, seized, or devalued at a moment's notice. Taking custody is you declaring your financial sovereignty. It is you opting out of the broken game and choosing to play by a new set of rules. Rules that are fair, transparent, and predictable. So, here is your call to action, your marching orders. Do not let this video end, and simply go back to scrolling. The clock is ticking, and with every passing minute, another few hundred Bitcoin are vacuumed out of the liquid supply, pushing us closer to that inevitable explosion. First, if you have not already, you must get a position in Bitcoin. It doesn't have to be a whole coin. Start with what you can, but start now. Second, educate yourself on cold storage. Buy a hardware wallet, set it up, and move your coins to it. This is non-negotiable. Third, and this is just as important, you need to share this information. The greatest tragedy would be for you to understand what's coming, and not to help the people you care about see it too. The mainstream media will not tell them this story. Their financial advisors, tied to the old system, will not tell them this story. It is up to you. Share this video. Send it to your family, your friends, anyone you believe deserves a chance to change their financial future. Be the signal that cuts through the noise. The storm that is coming for the traditional financial system is inevitable, but you don't have to stand in the rain. You can build an ark. Bitcoin is that ark. This is your warning. This is your roadmap. The signal is flashing, and it is screaming that a price explosion is coming. The choice is yours. Will you watch from the shore, or will you come aboard?